the future.
With changes to the tax laws now becoming certain, the consideration for an IRA account, individual retirement account, becomes more relevant than ever. One of the main reasons is that capital gains and qualified dividends, which had been subject to a better rate, made them more preferable for cash accounts. Because it is now almost certain that qualified dividends will no longer get a special tax rate and capital gains will be taxed at higher rates, the consideration for IRA accounts becomes more relevant than it has in the past. There's two types, as there always have been in the past: traditional accounts, which are deductible upfront and taxable when you withdraw, and a Roth account, which is non-deductible upfront, but also is non-taxable thereafter. Limits are $5,000 or $6,000 if you're over 50, and do recall in the last dozen years that spouses qualify whether working or not. The 2012 income limits for each type of plan, and given your marital status, are shown below, and those are for those people who have a qualified pension plan, which is indicated on your tax forms. For those without a pension, they generally qualify for an IRA regardless. A number of past examinations as to which type of IRA account is appropriate have been done, generally with the results being mixed or a push. Recall that a traditional, you get the tax deduction up front, and then you defer the taxes, paying them later. With a Roth, no deduction up front, but the income thereafter is entirely tax-free. Just about everybody agrees the sooner you start your retirement plans, either qualified pension at work or one of these IRAs, the better it is. And if you start at the age of 20 instead of 30, by the age of 60, generally you have twice as much. If you can do so with maybe a 2% higher return using low expense ratio mutual funds, saved by 2% again, you again double your amount at the time of retirement. What I'd like to do here is address all of these concerns with a fairly realistic example. I've used a high tax rate state, because they're deductible for both state and federal taxes, of about a third, let's say, and you're going to get a return, say, of 7.2% a year. That's a nice number because it exactly doubles every 10 years. And in a cash account, that means you would get a 4.8% return instead. Do note you will be able to fund your 2012 IRA account through April 15 of 2013. Let's first take the traditional IRA account. I'm using $6,000 for those above 50 because it's a nice figure given our 1/3 tax rate here. And you'll actually only have to come up with $4,000 because the other $2,000 will be a tax refund offsetting the amount when you open the account or make a deposit to it. In 10 years' time, it'll double at 7.2%, the total amount. But when you withdraw, let's say in 10 years' time, it'll be taxed at 1/3. You'll get the 2/3 of the gross proceeds. That's $8,000. So in terms of cash flow, you went from $4,000 to $8,000, which doubled and gave you a 7.2% return. Now let's take the Roth. You start off again with $6,000, non-deductible, so you got to come up with that full $6,000. In 10 years' time, at 7.2%, it'll double. Of course, it's non-taxable as a Roth, so you get the full $12,000 out, and again doubled in 10 years, giving you again 7.2%. Notice the cash account, $6,000 before and after tax, will only give you about $9,500, which is about a 4.8% return, which is, of course, the after-tax return in an after-tax world. The obvious point being made here is that having a pension plan, an IRA account of either type, is certainly more attractive. More subtle is that between the traditional, tax-deductible, and taxable deferred versus the non-deductible Roth, it does indeed seem to be a push. Now here's the subtlety. Notice with a traditional, you are only setting aside 2/3 the amount of cash. With a Roth, if you can afford it, you're going to have to come up with 50% more. You will have that much more in terms of total cash. But right about here, somebody pipes up, where am I going to get 5 or 4 or 6 grand? Whoa. Let's say you're under 50. You're going to open a traditional IRA account, deductible. You need to only come up with 2/3 the amount of money, the other third coming from your tax refund. Well, that's about $3,700. That's about $10 a day. You mow your own lawn or let it go rustic, saving you $20 from the neighbor kid. That's $1,000 a year. You've opened your credit cards that give you a $100 cashback bonus. There's 3 of them listed here. They give you 2, 3, 5% on gas, groceries, whatever. The grocery stores have extra bonuses. You limit the cable service or stop having that extra latte at the I'm too lonely to be alone cafe shop. You know which one I mean. You save on cigarettes by buying them at gas stations. I know you don't smoke, so okay, you cut back on that one latte a week. You've got your fluorescent bulbs installed. I bet you didn't notice fluorescent bulbs would save you $200 a year. You know, you've got your cell phone, so why not change your landline back to measured rate service? That'll save you a bunch of money. You're using your gas discount card. That's $150 a year. Cut your own hair. You know those ATM fees sure can add up. Get an account that doesn't charge you for ATM fees anywhere in the world. Get your senior discount coupons or clip your coupons and watch your tipping. You know who tips more? That's right, the not so rich. You got your grocery discounts. Look, this right here adds up to almost $3 grand. So you only got to come up with about $500-700 filing your taxes in terms of net cash flow to fund your retirement, which if you've done as I suggested, will either double or quadruple the amount you would have otherwise with Dr. C Invests.